Hi, and welcome to another episode of Monday Market Outlook. It was a tale of two markets last week as we saw one market reaching year to date highs and another market clinging on to dear life as the PSEI was able to hold itself within its critical zone at 6,500. Now, if we look at the PSEI chart, the market was able to bounce off of its support level at 6,388 to end the week within its critical zone at 6,508. Now, this was mainly due to the FTSE rebalancing that was concluded on Friday, which resulted in a net foreign inflow of investments. Hopefully, this momentum in the last two trading weeks last week would keep us on target to challenge the 6,585 to 6,650 resistance zone of the PSEI. Now, if we look at the weekly chart here, we can see that as long as we are able to stay within this critical zone here, the market has managed to bounce off this critical zone here at 6,387 to 6,360. Now, remember that a breach of this critical zone here could move the market towards its next support level at 6,250, which also corresponds to the 0.618 fib. The market has managed to bounce off of this critical zone, no, every time it hits these levels on a weekly basis. So we can see 1, 2, 3, 4, 5, 6, maybe 7 or 8 times that the market rejected this zone. So hopefully this gives us a better chance of pulling the market up to 6,650 and a healthy pullback to defend the 6,550 level. But we also have to be wary of what's upcoming, because remember that we only have 2 weeks before quarter 2 ends, and quarter 3 has traditionally been a very weak time in the markets, no? So if we look at the monthly chart and we zoom out, we can see that quarter 3 has historically been a difficult market for the PSEI. So look here, July, August, September, it's went down. July, August, September, July, August, September, July, August, September going down. August again very weak. July, August, September down. July, August going down, September bouncing up, and last year July, August, September with a big pullback, mainly because Q3 is where the ghost month happens. So going back to the daily chart, hopefully we can see a bit more strength in the markets in the coming weeks. Now let's look at some select charts here. BPI, as we said, this is a good setup for a swing trade. Always check that this is in an uptrend channel, higher highs, higher lows. So we were able to set our trigger price here at 102, and the BPI is currently at 107, so we're doing quite well there. Metrobank has pulled back and broken down several support levels. Is it a good time to buy Metrobank based on the pullback? Maybe not yet. The very strong downward move here may continue until its 51.55 support level, which also corresponds to the 61.8 fib. Let's see how Metrobank reacts to the 51.50 zone, but as it currently stands, its chart is not looking pretty good. Now URC, as we mentioned, could pull back to its trend line support here. We are right there, no, where there's a convergence of support 140 and trend line support. A hammer doji could mean a rebound in the next few days. Could be a good time to enter URC. Now, people have been asking me about REITs, whether if it's a good time to enter. A REIT currently at 34 is giving out a 6.1% yield. Is a 6.1% yield good or bad? There's no bank that would give you a 6.1% yield on a time deposit. The only bank I know that would give a 6.25 yield on a time deposit would require a 5 million maintaining balance, and you have to be a special client, right? I mean, this is a REIT where you can invest what, 10,000, 50,000, 100,000 and get the same yield at 6.1%. If you're asking what if the price goes down, if the price goes down to 31 pesos, the yield becomes 6.7. So what do? You buy more and you get a better yield on that second batch. Now take a look at A-REIT. It has managed to stabilize itself despite the market weakness that we've been experiencing. C-REIT giving a 7.3 yield, also pretty stable despite market weakness. Is it a good time to buy REITs? Of course. Given the good performance of our REITs, is it time to buy real estate stocks? The BSP rate as it stands is around 6.25 and our inflation rate is now below 6.25 at 6.1. So if BSP interest rates have peaked at 6.25, this could signal the bottom of real estate stocks. Let's look at Ayala Land. As expected, is now at its next support zone at 24.45, which also corresponds to a gap fill here. Could Ayala Land hold itself here, or could it make a move for another gap fill here at 23 and make another move towards 22.65? Now remember, 22.65 for Ayala Land. We have not seen Ayala Land at those price levels since July and September, and the last time before that we've seen Ayala at those levels was during the pandemic and way back in 2012. Are we getting Ayala at a real bargain? No? But looking at Ayala's long-term chart, we can see that Ayala is on a downtrend. The chart really, to be honest, is not looking good. It was trading at this range before. It traded in a lower range. Now it's trading in an even lower range. Who's to say it might not trade in an even lower range moving forward? But there's still a good chance that Ayala may have already found a bottom here at 22.65. We'll see how it reacts to these levels in the coming weeks. Now SMPH, on the other hand, has successfully bounced off of its 32.20 support. Now if we look at SMPH's long-term chart, we see a better picture, right? Because we are seeing here that SMPH has traded in a range for 6 years, right? So 32.20 has been a very strong support zone for SMPH. It has bounced off this level like more than a dozen times. And it has also consistently resisted 39.80 for quite some time. As we mentioned, in a sideways market, we always employ a buy low, sell high strategy, which means that we want to buy when the price is low and we sell when the price is high. When is a price low? If we look at the chart here, is the price, given this range here, is the price on the low side or on the high side, right? So it's in the low side. So here, this is the buy zone. This is the buy zone and this is the sell zone, right? Because this is the high zone, right? So we buy low, we sell high. So at this level, is SMPH a buy or a sell? Right? It's a buy, right? So we buy low, and when it reaches 39.75, see how it reacts to these levels. You hold, and if it pulls back a bit, first sign of weakness, you can top slice, take profit, maybe 30%, 40%. And then if it again goes back to these levels, 32, 31, you buy more. So at this point, if you buy at 34, are there any guarantees it won't go down? No. It can still go down to 29, 31, right? But again, there's more upside potential than a potential for SMPH to go down further. Somebody asked me about Converge last week, so let's look at the Converge chart here. There's a saying in the markets, of course, don't catch a falling knife. This definitely looks like a falling knife to me. Because if you look at the Converge chart from its IPO, it peaked at 45, now it's at 11. This for me, it looks like a meme stock. It's currently trading at almost its all-time lows at 11. Could there be a bounce potential for Converge? Yes, because from its lows before, it was able to bounce off like it was able to bounce off like 70%, right? But fundamentally, the company, for me, doesn't show any promise. I mean, it's an internet company. Where's its growth story in the next few years? I mean, the pandemic's over. Not a lot of people are subscribing to internet connectivity anymore. When they IPO'd, most of the IPO proceeds went to the pockets of the owners and wasn't allotted to any expansion or investments. Where's the growth going to come from? I mean, PLDT has Paymaya, Globe has Gcash. What does Converge have? What, a basketball team, right? So you can play with it, but this is quite dangerous. There's really no indication here of any turn as of the moment. Quite a risky stock to be in. Moving on to the global markets, we got a few things off of our plate last week. The core CPI numbers came out at 5.3, which is as expected, a slowdown from the previous month's 5.5, in a year-on-year CPI of 4%, which is lower than the expected 4.1. GDP also came in at 2.2, which was again lower than expected. So this resulted in a rate skip by the Fed, because we call it a skip because after the Fed meeting, they came out with the intention to raise heights a couple more times this year to a possible terminal rate of 5.6. If we look at the CPI numbers, the decrease in inflation was mainly because of gas prices. But if you look at the other factors here, we have motor vehicle repair, insurance, food, rent. No, these are sticky numbers. I mean, these numbers don't come down that easily. So given these numbers, there's still a chance that inflation might go up. So this puts the chances of the Fed hiking rates by another 25 basis points next month to 74.4%. And if you look at the Fed dot plot, we can see that most of the Fed officials are still looking at a terminal rate of 5.6% for this year, right? So looking at next week's activities, right, we will have the initial jobless claims numbers coming out and a whole slew of Fed speak in the coming week. But as it stands right now, the market still remains very bullish, with 45% of the American Association of Individual Investors saying that the market is still going to go up. Now, if you look at the S&P 500 chart, we were expecting a resistance level of 4,380, and the market just sliced through that resistance and went towards 4,450. Does the shooting star doji indicate a reversal this coming week for the S&P 500? We'll see. Now, looking at the options for last week, we can see that the market settled right in the middle of this call wall and a put wall here at around 441. Now, looking at the options for the 23rd, not a lot of options here, but we can see a lot of puts in the system, 4.8 put call ratio, which could mean that the market may still have some upside to go before it retraces. So we have a put wall here of 430, 435, and 440 and 445. So if we plot that into the chart, 430 here, look at the adjustment, no, 430 and 445, right? And then if we take out these lines, right, we have a max pain of 437. So we could potentially see the market retrace to max pain before resuming its upward move towards its next resistance at 4,500, right? So if we look at sectoral rotation here, the last 5 days, we are seeing some defensives creeping up the charts here. We have basic and materials, and we have industrials consistently on top. Of course, we still have your SMH, solar stocks, and your consumer discretionary. So we'll see how the market reacts next week. It's going to be a shortened trading week next week in the US as they celebrate Juneteenth Day on Monday. So trading will resume on Tuesday. So that's it for this week. I hope you enjoyed this episode. If you find it useful, please like this video, subscribe to the channel, and remember, good luck on your trades. Please manage your risks accordingly, and I'll see you again next week.